Things off, I'd like to just quickly draw your attention to the housekeeping slide that is currently showing on your screen. To start, you're all automatically muted, but we'll be accepting questions throughout the session, and you can submit these using the question tab below. We'll try to get to as many questions as we can. If we don't get to it during the webinar, we will follow up after the webinar concludes. If you are experiencing any technical difficulties, please click the support button, which is one of the bottom tabs on your screen. And finally, this session is being recorded, and all registrants will receive a follow-up email containing the slides, a link to the recording, access to register for future sessions, and the speaker contact details for all of us. A few months ago, BDO discussed how fintechs are the answer to innovation-led recovery. So it's great to see the federal government handing down key decisions that support startups, fintech and blockchain in the recent federal budget, not only through broader employment stimulus, but direct investment. To assist fintechs decipher what the changes mean for them, today we'll be unpacking the budget. On the panel today, I'm joined by Michael Bacina. Happy birthday, Michael. Partner in Piper Alderman's Fintech group. Michael is well respected in the fintech space as both a lawyer and a former developer and founder of a startup. Michael has a rare combination of technical, regulatory, and legal skills, which he leverages to assist his clients. Michael is also a key contributor to the RegTech working group for the National Blockchain Roadmap. I'm also joined by Nicholas Parry, partner, government incentives and direct taxes here at BDO. Nick has significant experience in R&D incentives, including product development, process development, and software, as well as experience in dealing with investigation departments responsible for administrating the R&D tax concession program. Welcome both. So apologies for those who dialed in last week. We had a bit of technical difficulties, so we had a fantastic session, just the three of us, but we'll do it again this week. And firstly, we'll just talk a little bit about some of the overview of the changes. This year's federal budget was markedly different to last year's, with a focus on tech companies and recognition of their importance. Michael, in your view, what sort of changed year on year?
Look, I think one of the biggest things that we've seen is the government come out and take a real push for the adoption of technology as opposed to the incubation of startups. So there was a lot of chatter when the budget came down and the Prime Minister's speeches around this. And that's, I suppose, a really different strategy for the federal government to take. And it's not an unexpected strategy because there's a huge number of businesses that are simply in the dark ages. Many law firms are still running on really, really old systems. So that kind of move to adopt newer technology in some ways, I think the government views as lower hanging fruit than going to try and push highly disruptive, Atlassian style and buy now, pay later style new models that could destroy businesses and create new ones.
And what do you think are the best outcomes for fintechs in the recent budget announcements?
Look, I think that everyone's been very excited about open banking, the first step in the consumer data right, and the move to substantially increase the funding for energy, CDR is really important. There's still some settings that probably need to be adjusted as we learn from that process as they go through, but that's a huge opportunity that extends all the way down from startups and other fintechs to get hold of data in a way they couldn't before.
Okay, we'll talk a little bit more about CDR later. Nick, I know you've read the Senate Select Committee interim paper. There were about 32 recommendations made to the government for fintech and regtech. Well, the budget delivered on some of
all.
Well, the budget delivered on some of these, such as R&D, digital identity, and regtech. What still needs to happen in the long term from your perspective?
Look, from an incentives perspective, there wasn't too much concrete, to be perfectly honest. I think there's still a lot more that needs to be done in terms of providing meaningful support, which didn't something different to what was already there. Like there hasn't been a demonstrated path or even a detailed plan yet. So there's a lot more to go, in my view.
But that is an interim paper, so
it is
from government. When you look at the expectations of what an interim report is going to have, and also the way these Senate committees work, there's I think a narrowing of what the recommendations are and then the deployment. And you and I are very excited to see the deployment and the detail. We just want it sooner.
We do want it sooner. I guess from tax side of view and from a grant side of view point of view, it's I guess skepticism over the years. I want to see more. At the moment, I'm seeing it as hopefully it's not just lip service. I hope they do more, but I want to see a bigger push. Definitely.
Okay. And Michael, I guess from a global perspective, we've seen a recent decline in the Hong Kong financial services hub, and the impact of the ongoing U.S. election Some say Biden's in, Trump still thinks he's in. I guess we'll see how that sort of plays out. How do you think this is going to have an impact on Australia's competitive position from a fintech perspective?
Well, they'd say there's lots of opportunity in change, and there's certainly a lot of change going on at the moment. We could place a friendly wager on the outcome of the US election.
We could.
So it'll be very interesting to see how Australia fares under a Biden administration, which will happen on the 21st of January on our side, particularly given that there's some policies that his administration is likely to take that are a bit different to how Australia's been traveling along. But I think the Hong Kong situation is, from an economic point of view, it creates there's movement of people, and the uncertainties around there may see a flight of talent back to Australia. We've long suffered from brain drain of talent leaving, and Australia being viewed as a great place to try out technology, but then fintechs moving offshore for funding and to access the US market. So I think that there's opportunity in that uncertainty, and where the US is ultimately going to go is still anyone's guess on a whole raft of things. But Silicon Valley is sort of a bit of a force unto itself, and California chugs along as one of the world's largest economies independently. So I think that these uncertain times do create opportunity for a country like Australia.
Okay. Guess we'll talk about this again in 2021. So let's move on to the budget now. I guess first let's start with a polling question, just in relation to, in terms of the budget papers. Have you read the budget papers relating to changes in fintechs? Because some of these first few questions will help us sort of frame the rest of the conversation. So we'll start off with a very simple question, yes or no. Okay, so primarily no, and the polling results. So I guess that's sort of good for our panelists here. They can sort of assume there's not a lot of people on the call that have done a deep dive into that. And I guess for the second question, again, even if you haven't read it, maybe the topics will sort of pique your interest in terms of some of the key changes announced in the budget, in terms of what's going to have the biggest impact on fintechs, and then based on this, we can make sure we cover these in the course of our conversation. So if you answer this next question, that'd be great. Thank you. Okay, let's see what the responses are. So tax relief for growth. So we're definitely covering that during today's discussion. And we're primarily covering all these particular topics. I guess the only one we're not spending a lot of time in is around, attracting talent. Nick, do you just have a quick comment in terms of, some of the changes in terms of JobTrainer that came out of the federal budget?
I do. To be honest, a bit of a case for more of a headline than the substance. There's not a large amount of money. I wouldn't recommend any business change what they're going to do, but there's certainly a benefit there. And if they meet the circumstances, I would pick that up and run with it.
Okay, and I guess if anyone has any particular questions on the budget after, again, please send through your questions and we can get you in contact with Nick or Michael. Let's move on to the digital plan. The digital plan encompasses a number of initiatives. Michael, you talked about the CDR rollout, earlier, expanding to the global markets, e-invoicing, digital business register, just to support the ease of doing business. Funding for the rollout of open banking is perhaps the biggest announcement for Fintechs as part of this plan. What has been announced to date?
So the announcement is really a substantial increase in the funding that's gone to CDR. So last budget, I think it was just shy of $45 million over 4 years, and the funding for the energy rollout of the CDR is pegged at 28.6 million, and then we're going to be moving on to other sectors. So it represents a nice increase of immediate funding available to go into getting the energy rollout happening. And as anyone's ever tried to look at energy plans and change providers, you'll know it's hideously complicated, and by design, I'd say, by the energy companies. So that's one sector that I think many people have seen for a long time would be massively benefited by people being able to pull their data down. And that also feeds into issues around energy use efficiency and climate change for those who are trying to manage their energy use. It's really, really difficult to get that data out, even for that purpose. So there's some interesting things that will come out of I suppose, the side of the energy CDR and ongoing learning. So that's huge. There is some balance needed around the accreditation for that process, because striking a balance between protecting consumers' data and ensuring that we can get innovation is really key. And I think, look, as we saw from the results of the poll, I think there's a bit of an understanding gap on things like the Fintech Bridge, and they're a bit more specialized for those who are specifically looking to expand overseas. So while that's being extended, I think that the funding over 4 years was 9 million for it, which in budgetary terms is not a lot, and doesn't create huge amounts of immediately available funding for those who are trying to access some government assistance. I think the export development grants probably provide a better basis for those fintechs looking to go offshore.
Okay. And I guess in terms of future considerations of the regulatory framework governing the use of financial data, I guess trying to ensure that there's an adequate sort of playing field. Do you think that tech giants are going to dominate banking and other services in the future?
Look, it certainly heads towards that way, because the way the accreditation is set up has had criticism because of the cost. So that by definition allows those who are better capitalized to move faster and get access and act as a gatekeeper for others. But in some ways that helps innovation by gatekeepers then being able to put other businesses under their wings to try and work out how they can work together. So there's a bit of sort of horse and cart, I suppose, of how the data is managed and how people can control where it's going. There's some interesting blockchain solutions that are unfortunately not quite there to be able to plug into this kind of thing yet, but we might see some interesting activity in that space that could help address these problems. But it's all, I suppose, the issue around data breach is so important, and we have a notifiable data breach regime here under our Privacy Act now. There's no point in letting consumers move data down easily to other businesses to try and compare and get better deals if that data then is going to be at risk of leaking, because nothing will ruin confidence in sharing data faster than large-scale leaks.
Well, you touched on a couple, probably two follow-up sort of questions. I guess in terms of CDR uptake, is it going as quick as you thought? I think when there's been, with the bigger banks starting to release sort of loan information, we've had some calls from clients about potentially doing accreditation. That's been a bit on hold. Do you think there's going to be a big uplift in people trying to be accredited in 2021? I
think that it's just given the state of where we are at with COVID and whatnot, I think that it's probably going to go a bit slower. As Nick and I joked earlier, we're all chomping at the bit, wanting these things to go faster, but there is both that accreditation process is complicated. This is for the rollout of the energy CDR, it's one of the few acts that has a summary description as its own division at the start of the act. So if you enjoy reading legislation, that's a warning sign. But if there's, here's a summary division of what the rest of the act's talking about outside of the normal summaries, that doesn't usually happen. So there's a lot of moving parts that have to be dealt with on a regulatory side and on the technology side. So it's always going to go slower. And coupled with it being the cost of accreditation leaning towards larger businesses that have more to lose in the event of a breach, they're going to be a lot more careful in that space. And we've seen, recent asset prosecution of financial license holder who failed to address cyber breaches. So a lot of those in the finance world are very, very sensitive to cybersecurity, and fintechs are also becoming more and more sensitive around that. Anyone with a financial services license will be sitting up and taking notice and spending an awful lot, I suspect, on ensuring that their systems are as secure as they can be.
And I guess in relation to privacy, you talked about that a little bit. I guess in terms of, do you think the current privacy laws are fit for the digital age, or what do you think needs to be changing?
So what do we call that? A lovely Dorothy Dixer. Look, the laws are always lagging behind technology, and our privacy laws were not designed for a CDR world or an open banking world. They were designed for a situation where people were for the first time handing over data in large swathes to internet companies largely. So I think the review of the Privacy Act is well timed, and also as GDPR gets bigger and bigger, that European standard is increasingly creeping overseas, and people doing business with European companies have to be, and European consumers have to be compliant. It wouldn't surprise me if we start to drift towards a more GDPR style of approach rather than our existing Privacy Act. We are a little bit different to a lot of other jurisdictions in how we address those privacy aspects. But when we're looking at trying to bring CDR into a consistent approach with other jurisdictions, we're going to run into that problem, that they're not going to want to have cross-linking and much easier access unless we have at least a similar level of protection. And GDPR has significant protections for consumers that our Privacy Act simply doesn't have right now.
I think it's a good point, because even some of my clients are starting to decide, do we need to go offshore? Because they have operations in Europe and the privacy laws are different there. So I think in terms of, Australia needs to be on par, globally, to make sure that we don't have more companies looking to go offshore. So I think it's going to be something that hopefully will sort of accelerate in the next year. I guess in terms of turning our attention a little bit to blockchain, do you see CDR interacting cross-border? You kind of alluded to this a little bit in terms of sort of blockchain solutions, but do you think, how close are we in terms of having sort of a blockchain solution, interacting with CDR and being able to operate overseas?
I think you're still probably talking about a couple of years for something to get widespread. We'll probably see something come out on a consortia basis, usually probably involving some banks. The issue is, when you talk about data, it doesn't respect borders, it doesn't respect jurisdictions, it doesn't care. It's just going to go wherever the internet noodles of cables send it. And so linking up things like CDR are great, but as anyone who's ever tried to enforce anything in a different jurisdiction, the legal systems are all quarantined, and it's very expensive to go overseas and try and prosecute anything. So that issue of enforcement causes a problem when data is going, personal information is going overseas, even under CDR rules, unless there's a clear enforcement mechanism. And one of those potential shining solutions for that is the consumer-driven distributed ledger or blockchain-based controls of data, so that it's the cost and accessibility of an individual reaching out themselves on a self-service basis to say, no, you can't use this data anymore, and it gets pulled out of the pool automatically under pre-agreed standards that everybody can see that are open, obviously with the actual data itself encrypted, is getting there. And there's pilots running for that kind of approach to privacy, and a number of startups that have been driving in that direction. But there's a little bit of chicken and egg there of, okay, this is a very powerful system, but without adoption, it's not useful. And do people wish to adopt it until there's lots of people using it? It's not a dissimilar issue to the early internet, when there was lots of networks slowly being plugged together until enough of them were connected, it became useful. So really, it's a standards problem. And we're blessed to have a lot of Australian representation on the international standards bodies around what's happening with DLT and blockchain that hopefully will help lay the groundwork. But again, it's one of these things that it's going to take a few more years, and we'll probably see some private solutions come out before we see some perhaps more consortia-based, internationally agreed approaches.
Okay. And I guess it'd be remiss for me to ask you what's happening with the national roadmap for blockchain, since you sit on the working group. Is there an update that you can provide in terms of some of the latest interactions with that group?
Well, the group has been meeting. All of our meetings are confidential, so I can't talk about what's going on there, but that National Blockchain Roadmap has been a wonderful initiative of the government. It sent a fantastic signal of Australia's I suppose, approach to innovation. And while many of us, of course, want things to go as quickly as possible, there is a process. Democracy in our system of government is slow by design, not by fault. And so these working groups that have branched off from the blockchain roadmap are moving along underway to prepare their reports to help, in a large way, educate huge amounts of government service and enterprise that still don't quite get this kind of technology. It's still very early days in many respects. So it's a lot of hard work. It's amazing to see all the brightest minds in that space and a lot of fintech businesses that increasingly are getting involved and seeing the benefits that they can get from this technology joining in. So that, I think, is, again, it's still a work in progress, but it is really good to see that traction and critically to have the government backing, because without that, there's still, a large pool of people who say, blockchain, isn't that something to do with money laundering and scams? And then they don't engage with that kind of technology. It's almost as if, the early internet never got past a reputation of illegal music sharing or something, and everyone today was still saying, isn't that just stealing music on some kind of computer and the kids use it? And then no one using email.
A Napster flashback. So yeah, so I think I think it's quite interesting. When I first moved to London, this is, I'll date myself, 1996. I packed my bags from Buffalo, packed my America Online CD that I needed to carry over to London to be able to access the internet. We've come a long ways from there. But I do think that blockchain technology is quite interesting because, even within the big BDO network, there's certain countries that are reluctant to deal with when they hear the word blockchain or Bitcoin, they won't even accept clients, particularly in that space. So I think even just from our perspective, it's an education process within our BDO network in terms of what we can or can't do in this particular space.
Are there any countries ahead of Australia or notably advanced in this field?
Yes, so Switzerland took a very early lead in the blockchain space, and particularly for a country so focused on the banking industry. So they recognized very early the huge benefits of it. So they have, I think they're, the last figures were a bit over 6,000 full-time blockchain professionals in Zug, which is considered Crypto Valley. So they've really been pushing forward. Some laws were passed very recently to amend, I think, a dozen different Swiss laws, including the securities laws, their version of the Corporations Act. And they've long had recognition of certain digital assets being able to be issued as securities in an appropriate way. So Switzerland is light years ahead in terms of getting regulatory framework, but there's such a different system, being a civil law system versus a common law system, that it's not as easy for us to look at and say, okay, we could just poach these bits of these laws and try and emulate them. But they're a really interesting market to see what's happening there. And then more broadly, the work that we'll come to in a bit on central bank digital currencies is the current sort of exciting jargon that a lot of the reserve banks and central banks around the world are getting excited about. And that may make a huge difference. But the government leadership and endorsement, particularly through CBDCs, helps incredibly, because I think you'll see those overseas offices in other countries start to say, well, hang on a minute, maybe we should rethink this. I mean, India had effectively a ban on digital currencies for a long time, which was not very well enforced and kind of ignored. But that sends a signal when the government says, this is not something we don't want people to do, and then to change and say, well, actually, we're going to make some laws to help encourage it is a big deal.
Well, I think you touched on the central bank digital currencies, I guess, in terms of, there's been a lot of stops and starts in some places. I know I was at an SEC conference probably a year ago where digital assets, aren't considered assets, sort of in the US, which gives a bit of an issue in terms of how do you account for, these sort of assets, which I guess is part of the reason why, accounting firms are a bit slow to come to doing some of this work. I guess in terms of, what central banks do you see that are adopting the digital currencies? You mentioned Switzerland, but are there other countries that are going to be quick to adopt that, and we're going to see a big change in 2021?
Yes. I could do a whole presentation on this area. In fact, I have. But I was just pulling up some notes so that I could speak to this with some details. So I shall try and be brief. Bahamas just launched their sand dollar recently. They ran a pilot last year, which was only about $100,000 worth. And then they've officially launched it. So it's out there, it's legal tender. It's a small country, so it's interesting to see these little countries that can roll it out and say, okay, this is all doable. Other countries like Estonia in Europe, where it's literally not even 2 million people there, like Sydney trying to roll out a digital currency. So it's a lot easier to get people on board. But particularly for the Bahamas, they've just used an e-wallet piece of software that people can have on their phones. When you're looking at these island nations, which have always had very local problems with remittance between islands, and problems with physical money moving around because they're islands and everything needs to go on little boats, they are really well served by moving to digital systems that can run on phones because smartphone penetration is really high. The biggest news, I suppose, in the last few weeks is that digital EU is basically on its way, and they're saying 2 to 4 years. So although it's been said as a hunch from some very senior people there, paper came out last month talking about it, but they've gone so far as to identify the full jurisdictional basis at law for both a wholesale CBDC, that is being a unit of account as between the central banks and all of the commercial banks, and a full retail digital euro being an actual digital representation of euro to replace coins and notes. With the EU saying a 2 to 4 year time frame, that's fast, but that's a huge market. And that is probably one of the things that will drive adoption incredibly quickly when it happens. You've already seen China do a massive pilot of their CBDC where they distributed digital red envelopes to consumers. 50,000 got these red envelopes, which had a time limit of spending. So because you can program central bank digital currencies, it's a really interesting thing that can be done in that way, like the red envelope program of here's, I think it was the equivalent of like 25 bucks, it wasn't much, but here's some money, you've got 30 days to spend it. And that's fascinating because when you have economic problems like we've seen with COVID, a government being able to issue money that cannot be put under the digital mattress, as it were, or stashed away, but has to be spent, is a really valuable monetary tool. So that pilot has finished, but that was the largest ever pilot, and we haven't seen published reports on it yet. The China one had a huge amount of surveillance over it, which is no surprises there. So we're looking for theirs to be a highly controlled, centralized CBDC that will not really be like a true digital cash, but will be a manner of tracking things. Canada has said, we're going to do it if we absolutely have to, and are working on a retail CBDC if their monetary sovereignty is threatened, which is a really neat approach that I wish Australia was following, because they're building the technical capabilities in the government. So if required, they'll roll it out. But if they don't have to, they don't plan to. And that's, I think, a really nice approach. The Americans have said, look, we don't really want to, but when the first COVID stimulus went through, I was fascinated to see that the very first bill that was issued had a fully fledged regulatory framework for a CBDC going all the way back to the Fed in the legislation. So I stayed up till 1 a.m. reading it going, this is amazing. I wonder if this is going to sneak through Congress. And unfortunately, 12 hours later, draft 2 removed all of the digital currency in there. And Australia is, I would call us slightly ahead of the Americans, but not quite at the Canadian position. And the Reserve Bank's doing some really interesting pilots. And the Reserve Bank here is not an organization that has been historically renowned for innovation. They enjoy a reputation of being very solid and conservative and slow moving and being careful stewards of interest rate policies. So for an organization like the Reserve Bank to have a full innovation lab and be looking at wholesale bank settlement using something like Ethereum, which is what they've been running some pilots on, is really exciting stuff for Australia. So that's the very short flight around the CBDC world.
Well, I think that's going to be quite fascinating, because you can start to see some real practical uses of the digital currency, but particularly as you mentioned COVID. So in terms of the ability to get digital currency out to people that as part of a stimulus package is going to be quite an interesting sort of concept. Hopefully we'll move on from the pandemic and it'll move on to some more practical sort of uses.
Yeah, like you could like program where people spend their money.
Yeah. So if I flash back to my time in the US and sort of some of the programs that they have there in terms of handing out unemployment money, for example. So you can just start to see making sure it's being used in the right way or tracking that. So I think it's going to be a lot of sort of social uses. I think if a lot of my clients are more interested about how do we launch a digital fund, and so you mentioned Bahamas, we've got some funds that are started in the Caymans, so a similar sort of concept. It's going to be interesting to see, I guess, investor confidence, sort of, I guess, in digital currencies. Do you have a sense, either one of you, in terms of, are investors really becoming quite keen and interested in terms of investing in digital currencies?
Well, I've certainly seen some of my clients use digital or Bitcoin-based concepts for investment and capital raising. How that translates to the very different world of tax and legal forms of equity is interesting. Something to consider.
Look, with Bitcoin rolling into all-time highs again this week, the interest has jumped. I've had a whole pile of new inquiries coming in, as it always does whenever the prices go up, of funds in particular, saying we'd like to get into this. But I think that the interest and the size of that space is still minuscule next to the traditional financial market and pools of funds. So it's still very, very, very young and little, but it is growing. And I think it's significantly growing. I think one of the interesting things about the last week in the cryptocurrency markets going up is someone circulated a graph of the number of Google searches for Bitcoin and other cryptocurrency terms, and they haven't gone up this time. So there isn't a dramatic, I suppose, just general users out there trying to look at it. Either that means people are getting more educated, or this is a different kind of movement in the market. And there's been a lot of institutional money moving into the digital currency space. You saw a lot of people making fun of JP Morgan for having done a complete 180 from several years ago and criticizing and saying it's terrible to putting in heaps of money into the space. And a few listed entities, I think in the UK, were putting significant percentages of their asset holdings into digital currencies because they just saw that it was likely to go up significantly. But the really interesting part about it is that technology around, say, enabling, in the fund example, enabling, say, automated withdrawal of someone who's putting money in, to say you can take this out at any time. We don't even need to be there and push a button to allow it to happen or move funds out. But perhaps there's an automatically programmed in discount that you'll suffer if you take a redemption, or the tax that'll have to be done gets automated and gets tossed out to the government. That kind of automation and efficiency is really what most of that technology is about. And a lot of fintechs have been driving in that space for years on a centralized basis, but the decentralized or partially decentralized or distributed automation that blockchain brings is fascinating. Like when the government really clicks to, hang on a minute, we could collect part of the GST on every sale at the till and get it in the government's coffers that seconds after a transaction happens, or see what the spending is this morning in Sydney on coffees to see whether or not people are coming back into the city for COVID. I don't have to be having scary surveillance of what we're doing, but even that kind of spending data is so useful at government level, but also for businesses to say, okay, this is happening, we can respond in this way. And then being able to program an automated response, that's incredibly powerful, and it's just not possible in the old centralized siloed way of building out proprietary technology. It's only possible in these shared systems.
But like going back to your previous point, so investment via blockchain or equity investment via blockchain at the moment is minuscule versus the traditional market. There's obviously obvious differences. What would it take to convince someone who knows that the regulatory framework around number of shares, assets, values, valuations, compared to investing in something which can change daily on supply and demand, how you devise blockchain, how you value the services, that kind of concept.
Look, it's a tricky one, right? Because a lot of people are invested in a lot of things that are horribly illiquid, and even listed companies, especially down the penny dreadful end of the market, have awful liquidity. When Facebook first floated, they had some liquidity challenges in the first 24 hours just because of the balancing up the orders. So liquidity is a huge problem, but the interesting thing about that kind of super transparent, super public approach is it just exposes that the price discovery is there, but it's also a huge amount of potential manipulation. And that is a massive problem. So I think that investors on the public blockchains will have issues because of that technological quirk in their design, that if you want a transaction processed quickly, you pay more of a transaction fee because transaction fees are not flat. So when an investor figures that out and they say, well, hang on a minute, if I go and place an order on the ASX through my broker and pay a flat rate of brokerage, I'm just in the queue and it's a first place, going down based on the price that I'm bidding. But in a blockchain system, if you wanted to, and there are people who do it and have automated systems, you can pay to have your trade front run. So there are people doing high-speed trading in the blockchain markets using price signals to race ahead and just pay to be at the front of the queue. And they don't have to pay that much because the fees are so low. People were moving billions of dollars around a few weeks ago for $50 fees. And so these kinds of transaction fees enable that kind of manipulation to happen as a matter of course, which makes investors nervous and regulators nervous to say, well, hang on a minute, this is a market where you can pay to get to the front. And so you can do if you have the power of the algorithms to work it out, you can really own the market. So that makes people nervous, but that's separate from those saying, hang on a minute, the technology underneath is incredibly useful. There's some great offerings to just use that power to then put a skin on it. No one needs to know it's running on blockchain, in the same way that you don't need to know how the electricity works for the light, enjoy the light in here. And that is the area where I think there'll be an incredible amount of growth, where you'll still have the so-called intermediaries that a lot of the blockchain maximalists wanted to go away. Turns out they do actually add value because they help people solve their problems, but can use that automation in the back end.
Yeah, no doubt.
So Nick, I know you're trying to avoid this, but we're going to move to R&D.
That's what I do every day.
Yeah, so I guess probably one of the biggest signals of positive change in the budget was the announcement of the R&D incentive, with proposed changes to take effect from July 2021.
Yep.
Initially, the government, planned to cut the R&D incentive for small claimants, which obviously would impact a lot of our, sort of fintech listeners and some of our clients. So I guess in terms of this is a great in terms of supporting growth.
Yeah.
So obviously, there's been a clear push from the tech sector for the government to reconsider this. I guess what's your view in terms of the change in the R&D incentive, and I guess how do we get to this from the federal government?
Well, headline is that it was really good news, very good news. So the government, they've always had a perceived problem with the R&D tax incentive. They kind of have to have one because everyone has one. But lately, the signals from the government, we spoke about signals earlier, they're negative signals, and they have been trying to discourage and reduce the cost of the scheme. And so the previous bill that was proposed, they were hoping to cut $1.8 billion out of the scheme over 4 years, which was quite significant. So, so with this bill, or with the budget announcement more accurately, so what they've done is put any changes on pause. So the changes were proposed to come in for FY19 and FY20, which have already passed. So that's on pause. So it's steady as you go, or the current regime applies. With the new bill, it's due to come in at 2021, and overall it is positive. For small businesses, I'm not sure if it's as positive as it's being portrayed. For large businesses, it's very positive. So there's a distinction in the R&D tax incentive for companies more than $20 million in turnover and companies less. So quickly touching on the larger companies, which is probably not that many fintechs, but the larger companies, the most contentious measure was the introduction of something called an intensity measure. Right? And so this intensity measure, based on your level of R&D intensity, that determined the rate of benefit that you got. And if you were at the lowest tier of intensity, the proposed changes were to give you a benefit of 4 to 4.5%, depending on which version of the bill, which was almost at a level where you question even claiming. With the new bill, the lowest tier now has an 8.5% benefit, which is the same as what it currently is, but more importantly, anything above the lowest tier has a 16.5% benefit. So it's very good news. For small companies, the previous proposal was to cut the refundable offset from 43.5% down to 41%. They've now reverted back to a 43.5%. So it's not massive. If you're in a tax-paying position, it is a lot better, but the headline refundable amount is about the same. If you were the recipient of a very large refund, it's definitely positive because the cap on a $4 million refund has been removed, so you can now get any size refund. And certain companies, there's not many companies, but certain companies would welcome that very much. But the R&D tax incentive really is really two sides to it. So you've got the legislation and all these hard numbers, and then you've got the way that the government administers it. And there's been a lot of press around the administration of the scheme, particularly for software. There's been some very high-profile cases in the media. Airbnb was another one. Commonwealth Bank's claim reduction or abandonment was another one. I think it was a reduction. And so that's a negative signal. And obviously, within the fintech industry, there's countless stories of companies being targeted and having their claims rejected. That there's been no evidence that that has changed significantly, and that's the most disappointing part. There has been some change, and the small changes that have been made are positive. There's been a few wins for the taxpayer, there's been a few losses for the taxpayer, but we're hoping the ship is turning around slowly, but that's the situation right now, okay, unfortunately.
Okay. I guess in terms of just, if you want to touch on just a few other sort of the tax relief measures from the budget, there was a simplification of the export market development grant scheme.
Yeah, that one's an interesting one.
Yeah.
So the export market development grant is a great scheme. It at its fundamentals, it gives you a 50% rebate of your marketing expenditure. You have to identify an eligible product, and for software, you have to develop that product in Australia, or mainly in Australia, to be in the game. And then if you go and market that product overseas, then it's great. You can't market to New Zealand or North Korea because North Korea has a nuclear program or something, and New Zealand have to be excluded.
Fair enough.
So one of the main, so the measures they're trying to introduce or proposing to introduce is aiming to address one of the, or two of the issues that with the scheme as it currently is. So there's a fixed pool on the market on the EMDG, and the government hasn't topped it up to keep pace with the demand, and so that's resulted in lowering payouts. So theoretically, you get a maximum grant of 150. Realistically, that resulted in grants of about between 90 and 110, which is disappointing. It makes it difficult for business to be able to plan what they can spend because they're uncertain of the amount of rebate. So this measure changes it from applying after the event to applying before the event. So you're seeking pre-approval. It's introducing 3 different tiers of exporters new to the scheme, new markets for existing exporters, and expansion of present markets. At the early phase, the grant entitlement has lowered to $40,000 per year over 2 years. Where you moved into the next phase of expanding into new markets, you can get $80,000 a year over 3 years, and in the growth phase, so to speak, it's $150,000 for 3 years. So it seems like the government's trying to balance what they've got in the pool to share it around more equally to try and tailor it to, I guess, the journey, as they call it, of exporters. It does seem a little bit more complicated, but hopefully it does provide more certainty.
Okay. And I guess if you just want to touch a little bit on the incident asset write-off, I guess how that applies for fintechs, what they should be aware of.
Again, another good news piece. So the instant asset write-off is really an extension of what was there before, but it allows for the deduction of an asset of any value. With any deduction, it's only valuable if you have tax to pay. If you're not paying tax, then that deduction is just a deduction. It just sits there as a carry forward tax loss. So in that respect, it's going to benefit some, and for others, it's not really an event. For software in particular, for fintechs, it's probably a little bit questionable as to the benefit. If a software company is claiming the R&D tax incentive, they get the deduction for that amount anyway. So it's positive news, but it's not groundbreaking.
Okay. Let's move to regulation. We can't really talk about, I mean, obviously that goes sort of hand in hand in the fintech financial services space. So far, I guess if we look forward to, what's going to happen in 2021, I mean, looking at the Senate issue papers that are going to be released, what are you most focused or most interested to read, Michael, Nick?
Well, I always like to see what's happening in the blockchain space, but I think there's a huge amount happening and a lot of talk happening. Earlier this year, we had the famous Wagyu and Shiraz case with responsible lending, and having recently gone through a loan and having to face the pain of responsible lending checks, I kind of firsthand understand why people would want them to be perhaps pared back to what they were before, but there's been a lot of Chicken Little, the sky is falling with the onerous responsible lending rules that came into place. And I had heard just, on the grapevine from various people that, some lenders were finding just the pain and suffering of the administration of dealing with these new requirements so much that it was hurting the models for lending in a very, very low interest rate environment where they're not dreadfully profitable lines of business anyway. So trying to settle down a clear position on responsible lending is something that I think will be really useful. That I don't think it got a mention in the second Senate issues paper around that. I think they're a bit more focused on things like the CDR and ensuring that and access to capital is a big one, R&D as well. I echo Nick's comments. I think the pullback of the attempts to cut a lot out of the R&D budget for Australia is really a great thing to see. It's a stimulus by another name, but a very, very targeted one on a sector that could pay huge dividends later on. So I think it's a really useful budget line item and very, very supportive of the whole fintech industry versus a Kevin Rudd style checks for all and buy fridges and things, because here you can't buy a fridge unless it's a digital fridge that has something to do with research and development in your special plan that's all approved, which is much harder to squeeze that kind of thing through unless you had some really, really crafty plans. But I think that support and keeping that moving forward, plus what's happening around CDR and supporting these blockchain initiatives is what I'm most excited to see. I think there will be a lot of, in the final report, issues that Nick will look at and go, oh, it's a bit too broad and motherhood statements, but that's the nature of the game.
I'm very happy to see that it's still on the agenda, it's still being discussed, it's still taking submissions. So while they're still talking about it, the more conversation we have about the blocks and the issues and the regulation and the applications and getting things approved, the better, because the better the chance that we'll get a positive outcome that will benefit the fintechs.
Okay.
And I should also add, it's great to have, we have an assistant minister for fintech in Jane Hume. There aren't very many countries in the world that actually recognize a portfolio specifically for fintech. That's great. And Senator Bragg, leading the Senate committee, I've had the pleasure of meeting him on a number of occasions, and I don't know when he sleeps. He's a powerhouse, a very, very sharp guy. So he's definitely the right guy to be chairing that. And the whole committee are really, really interested and knowledgeable. It's always a great reassurance when you can see leaders like that who just understand what's going on. They understand where the technology is and the opportunity. If you were just reading newspapers and having that kind of view of what's going on in Canberra, you might have not as positive a view, but if you get up close and actually have those in-depth discussions, they really know what's going on. And so I think that I'm very excited to see the final report and see how that feeds in. And I think it's already what we've seen in the budget. Part of those interim report recommendations are probably already being reflected in there, and in the issues paper they flag some of the funding items that are of use and how they're going to be pushing forward. So I think that'll be really exciting to see that final report come out.
So Nick, just a bit of a slight curveball in terms of the Australian federal company tax rate.
That's a lovely topic this time.
Yeah. I guess do you envisage change in the tax model to support, I guess, tech investment? Because I guess I've lived overseas, Michael's overseas.
It's always an interesting topic, isn't it? Like, what should be the corporate tax burden? What's the right level? How does Australia compare to other countries? What's the US doing? What's the UK doing? The UK is almost a tax haven these days with their corporate tax rates, and people are going to the UK. You can't ignore that. So at one level, in the idealistic world of tax policy planners, they want tax to be agnostic of industry and to be to provide a level playing field. But you can't ignore the value and the benefit that innovative companies provide to a country. And you can't ignore that other countries recognize that and then doing what they can to pull those innovative companies to them. So Australia has to respond. I think we are lagging behind. The UK is well ahead of us in this respect, well ahead. Even from a pure tax incentive perspective. It'd be remiss of me to advise someone to choose Australia over the UK purely on the benefit provided because it's great over there. So I'm hoping that the government can do more and recognise that they must do more to attract and retain innovative companies here.
I'll talk to you later about the tax rate. The I guess we have a few minutes left, and I think I just wanted to cover a real topical point on buy now, pay later. And Michael, I guess it's on the fringe of regulation. There's been plenty of self-regulation that's been happening in that particular space. What do you think is going to be happening from a regulatory perspective in the buy now, pay later space?
Look, I think that there's it's a real crystal ball gazing question, and given that it moves so fast, and even the news from that Austrac decision a few weeks ago in relation to Afterpay, it's a space that's going to continue to grow. I think that there's an opportunity for that self-regulation to come in. I think they have a really interesting approach that's technologically driven to their version of what you might call responsible lending, which is markedly different from how traditional lenders have dealt with it. But it's still an area that is obviously on the radar of the government from a consumer protection perspective, but has become so big so quickly that it's very difficult for it to be dealt with in any way other than carefully.
Yeah, the horse is bolted, doesn't it?
Well, that's right, and it's honestly being seen by more and more people, particularly on a generational shift, as a credit card replacement. And in many respects, I was even joking with a member of our office who just had her credit cards stolen the other day and her bank account cleaned out, and my wife's credit card got cloned last week, and she rang me up and said, "Did you spend $5,000 at Bunnings?" I was like, it could happen. It's so addictive when you go in there for a screwdriver and come out with $5,000 later, but no. But even as a side weird issue, buy now, pay later programs just can't be broken like that. You can't have your credit card swiped if you're using buy now, pay later. So they represent this really interesting shift to me of a completely different way of doing purchasing that is totally different to that credit card model.
Yeah, even with that separate credit card, you can generate a credit card and it's gone 24 hours later.
That's the point. It's the security around it is something that's just not been considered. And there were all those headlines the other day of 20% of customers are late, and then you look at the actual data and it's one of the companies had 20% of people paying late fees, and my first thought was, well, I'd like to see how that compares to people paying 25% interest on their credit cards to see is that higher or lower, because that could just be a standard level of, okay, for people who are late, that's that. But there's always a tension with anything around that kind of provision of credit or quasi-credit of, okay, well, if it doesn't exist, what's going to rise up in its place? And I think this is eating into credit cards. So inevitably, there's going to be some more regulation around it. But I think there's still plenty of opportunity for the industry to show that it's doing the right thing. And even the rate of defaults that these companies are seeing, which are very low single digits, are way below credit card numbers. And even that alone, I think, makes a lot of people more comfortable at the regulatory space to say, well, is there really a problem that needs to be fixed here if the costs that are being paid to access this form of quasi-credit or credit is much lower than at a credit card level? And what's happening? Is there something actually happening that needs consumer protection? Because it's easy to swing in there and say, well, we're going to make a bunch of laws around it, but they have to be assessed as to whether or not they're A, needed, and B, what the impact will be, and whether that just means people will again go offshore and try and offer products into a country in a way that's a bit more grey, and that won't serve anyone in Australia to have that happen. So I think it'll be a space to watch very, very closely, and you're seeing a lot more people coming into the space, and that also is usually a precursor to some kind of greater regulatory scrutiny.
Yeah, I would agree. I guess with only a couple minutes ago, Nick, any sort of closing thoughts in terms of, if we look forward to 2021 in terms of the fintech space, what's a priority for their success? Any closing remarks?
Access to capital, access to funding is obviously the major story for fintechs. Creating an environment within Australia to make it easier for startups and fintechs to get capital access, whether it's through tax incentives, investment incentives, whatever the case may be, it needs to be improved.
And Michael, closing thoughts from you?
Look, I'd echo that as well. From a startup fintech perspective, Australia has some real challenges in its pools of capital to be available for startups, and so we've started to see more E6, I think, more VCLPs come about. There was quite an absence of many of them for a while, but they're becoming a little bit more popular. So I think as that understanding of those mechanisms spread, and we perhaps look at more efficiencies around supporting more investment in there, and perhaps even encouraging that huge pool of super money to be able to get back into innovative investments, because right now, obviously, unless you're running a self-managed super fund, it's just not available.
Yeah.
So even larger superannuation businesses being able to access that, I think is going to be very helpful. But that's a huge problem that is, no real immediate lawyer can fix it. It's a government problem to fix with policy settings, but that could make a huge difference given that where jobs come from in Australia being generated by small business, i.e. a lot of startups, whether they're a tech startup or a small business startup. So supporting those, I think, will be really, really important as we come out of, fingers crossed, COVID in the next 1 to 2 years and start to get things moving again.
Hopefully that will be the case. Well, this concludes our discussion. So Michael and Nick, thank you for your time and contribution. I'm sure everyone, really liked your valued insights there. You'll now see on the screen details of our next webinar. You think both of you talked about capital. That happens to be our topic
Very good.
for December. So we're actually having someone from the ASX come in to talk about, almost to have a look back on 2020 and look forward to 2021 on the ASX, because we're seeing a lot of, obviously, activity with Fintechs coming overseas, trying to list here, and Fintechs that are trying to list as well. So that will hopefully be a good session. So we have a December webinar coming up, and then we'll be taking a break until February. The details of this webinar will be shared with you following today's session. If you missed the first webinar, my team are adding links to watch this. And before we close the session, we'd appreciate if you take a short survey. And thank you for joining us today, and hope you can join us in December. Thank you very much.